Well, joining us now is Neuberger Berman President and CIO Joseph Amato. Joe, it's good to have you back on the show. Contrarian take by Jeff Gundlach there. But given the fact that we are seeing this loosening in the labor market and we have this 50 versus 25 basis point cut, and then, of course, what happens after that in the following meetings, what the dot plot tells us tomorrow from the Fed, how do you see this economy?
Well, I do think the economy is clearly weakening. The question is how far is it going to go and what the Fed's response is and how quickly that's going to take effect. But as we've seen over the last number of months and quarters, you've seen slow and steady sort of weakness in the labor market, and you have other indicators that are showing some stress on the consumer side. Now, the overall macro numbers remain in decent shape, right? The GDP Now numbers right now, I think, are in the mid-twos. And the retail sales number that we saw this morning certainly tells you that we're not falling off a cliff per se, but clearly there's weakening going on in segments of the economy, and I think an aggressive action on the Fed is warranted.
Does it make sense then to be seeing the S&P 500 at record highs?
Well, I think you've got to appreciate the S&P 500 is not necessarily reflective of the overall U.S. economy, right? You're talking about 500 stocks that are world-class, globally competitive stocks that don't really need to go to the banks to borrow money. They can go into the investment-grade bond market. So, these companies are doing great, right? But as you get below the S&P 500, you move into small-cap land. As you move into micro-cap, never mind private companies, they're seeing the stress, right? Small-cap earnings have been down a number of quarters in a row in the sort of double-digit percentage range. So I think that's more reflective of what's going on in the overall economy.
Joe, great to have you back. So are bonds back as an effective defensive play in portfolios?
Certainly bonds, I think, are proving to be a quite defensive play in the portfolio. And the correlations that we saw back to 22, where people question the validity of a 60-40 portfolio because of that higher correlation of equities and fixed income, I think that's shifted, right? So, the fixed income markets are now driven more by market forces, not suppressed central bank rates, and I think are increasingly an important part of the portfolio because you can get better returns there. I mean, simple as that.
So on international markets, India has been doing really well, but outside of that, where do you see opportunity?
Well, the other market outside the U.S. that we have been bullish on for the last couple of years has been Japan. We think there are a lot of very important secular changes going on in corporate Japan that are going to transcend whether the yen is weak or they shift monetary policy modestly in the short term or what have you. I think the long-term changes are that CEOs, management teams of Japanese companies are much more focused on delivering better returns for shareholders. The typical ROE, or the average ROE for the Japanese equities is in the 6 to 8% range, right? The trailing 12-month ROE for the S&P 500 is 21%. I'm certainly not saying that you're going to see 21% ROE for Japanese companies, but if 6 to 8 moves up higher because they're more focused on reducing assets that are not particularly efficient, returning capital to shareholders to drive better returns, I think you're going to see a long-term secular improvement in that market.
How do you factor in or position yourself against geopolitical risk, which is rising? I mean, we saw this pager attack on Hezbollah earlier today. Certainly tensions in the Middle East have been flaring, whether it's there, and crude perked up a little bit in response to it today. But whether it's there or Ukraine or just election season, other parts of the world, how do you manage that as an investor? Is it something you think about?
Well, certainly it's something we think a lot about. I think the volatility that gets factored into the markets or that's reflected in markets from the geopolitical problems are just a reality of how you've got to manage portfolios. So you want to keep some powder dry to take advantage of big swings in markets, like what we saw in early August, where you had a big unwind of, if you will, the yen carry trade, and that created opportunities, whether it be in the U.S. or Japanese equity markets or what have you. So I think you need to keep powder dry, and we expect this volatility. We're at an important inflection point. We think tomorrow is a significant day in this cycle, in a sense that we've been fighting the headwinds of high rates for a while, seems like forever. And now you're going to start a rate cut cycle that's going to be important, and you want to be able to take advantage of that, but realizing still that there are dangerous places in the world, and there are elections, particularly here in the U.S., of course, where policy differences might have meaningful impact on markets.